Welcome back to the exchange. Existing home sales falling more than expected as June. High interest rates, low inventory, but the National Association of Realtors said sales dropped 5.5% to a rate of just under 4 million units. Meanwhile, the median home price soared to a new all-time high. Look at this number, 420, let's call it 427,000. Incredible. The second straight month of record highs as well. But are there some signs of normalization as the Fed's on the cusp of cutting rates? Let's ask Ivy Zellman. She's Executive Vice President of Zellman and Associates. Ivy, it's great to have you to try to explain this sort of wonky housing market to us. Is there a change? I see more for sale signs.
Well, first, thanks for having me. And it is a wonky market. Never have we seen volumes as low as they are in the face of what has been very strong home prices, as you pointed out. I think affordability remains stretched. The good news, though, is that mortgage rates have come down a notch, call it 25, 30 basis points, which actually equates to about a 3% decline in price. And with that, though, we're still at about 20% above trend line. So I think we have a ways to go. Inventories are rising, though. The report showed that inventories increased 23% year over year. Last month, they were up 19%. And there are markets that are up substantially. Markets in Florida up 80%, Denver up 80%, 70%. There's lots of markets seeing very significant increases in inventories, which actually makes it more likely you'll be in a buyer's market with more product available.
That's something I've seen anecdotally as well. People are sharing their Zillow maps, for instance, and saying, look at all the new listings. So when you say like Denver inventory is up 80%, is it so low that it's still low, broadly speaking, or is it starting to become normal or even high?
Actually, it was up 70. I got that one wrong. You're right. It actually is still on a relative basis fairly low. And I think that, when we compare it to pre-COVID, inventories are still pretty low. I think what we need to see for the market to get to a healthy level, we need to see inventories continue to rise. But I'd say with those markets that are up 70, 80%, they actually might be slightly above where we were pre-COVID. So wow. I think that's a bad thing. I think that we need more product availability so people can actually go somewhere if they sell their home. I mean, you hear people not only are disincentivized because they're locked in at a low rate, but they're like, where am I going? Where am I going to move? Right.
So that's why I wonder if this all turns at the same time. If we see falling rates, improving affordability, people start to think, OK, maybe there's somewhere to go because there's more inventory. So falling rates mean falling prices or squishier ones where high rates have been higher prices. So it wouldn't have made sense 15 or 20 years ago. But I don't know what you think about where that leaves prices today.
Well, prices did decelerate in this month's report, and we expect further deceleration as inventories are rising. And one thing I'd point out in the markets in the Southeast, Southwest, those markets more so than Northeast and Midwest, where there's a lot more new home construction, we're seeing a lot more competition because they do have alternatives. And I think the builders are continuing to start a lot more homes, and they're significantly incentivizing. In fact, the premium that a new home used to warrant was, call it 25%, in some markets 25%, that premium's gone completely, and they're on par with existing homes. So builders are offering a lot more value. So that's going to mean that the existing home seller is got to come away from their aspirational asking price and come back to realization that they're going to have to reduce their price if they want to buy that new home, and that will be a better value for them.
What level of mortgage rates do you think we start to really see a sea change in the market? Because I'm not sure if it's 25 or 50, but again, we're talking about the overnight rate, and mortgages usually key off more like the 10-year. Maybe that's anticipatory. I mean, so, do we need the 10-year to come below 4 and rates come down half a point? I'm curious what levels you think are significant.
Well, we think about, call it 50 basis points kind of equates to 5-6% decline in home prices. So if we're, call it now on new homes, we're a little bit better, call it 15% above trend line. Again, an existing home, 20% above trend line. We'd probably want to see mortgage rates come down at 100 basis points. They're hovering below 7 right now. So I think if we had a 5 handle, even in the high 5s, I think the market can start to see more momentum. I think that many people that are locked in, again, over 80% of homeowners today that have a mortgage are locked in below 5. So again, that disincentive and thinking, wow, I don't really want to give up this low payment I have, does give some pause. But now when they say, oh, it's not that much different, maybe, I can think about moving and it doesn't feel so bad.
That's interesting. So really a full point of cuts is where we could start to see a bigger change. Okay, the next I would ask you about, last thing before you go, is placed all of my favorite things. Contrarian, favors New Jersey, all the rest of it. The San Francisco Fed has just done a little study suggesting that migration from colder parts of the country to the Sun Belt is slowing. And you've probably heard this. I've heard this in REITs and certain real estate markets as well, this idea that climate change will make the South so hot that people will start to move back. I mean, tell me, do you think this could ever possibly happen?
Well, I'll get on my soapbox now because I do agree that that can happen. And in fact, the migration has been slowing. We just saw the Allied Van report that showed a double-digit decline in 23's number of people that are moving, obviously taking a moving truck, and that was on another double-digit decline in 22. I don't necessarily think that's associated with climate change per se, but I do believe that as we start to see more storms, the market that, unfortunately, the Texas market that just experienced Burl, there were commentary coming out from local papers saying people are contemplating leaving. With respect to markets that are extremely hot, I mean, if I'm living there and I can't take my dog out for a walk,
Sure.
I think it's going to be problematic. And so I do think that markets in the Midwest that are more affordable, that currently are enjoying 80 degrees and beautiful summers while other people are boiling, might become a lot more attractive.
New Jersey? Come on, can we be in the mix? Do you think maybe they cut property taxes by about 70%? We'd have a chance.
Yeah, I think Cleveland, Ohio is a good opportunity. In fact, inventories in New Jersey and Cleveland are two markets that are seeing the least inventories in terms of year-over-year increases.
All right. Ivy, a story to be followed for sure. That's interesting. Maybe there is a change going on there. Thanks for joining us today. Really appreciate it.
Thanks for having me.
Ivy Zellman with Zellman and Associates.